There's this really persistent, almost stubborn myth about farming. Like, it just lives in our collective subconscious.
Oh, absolutely. The whole pastoral ideal.
Right. Like, if you look at a yogurt commercial or I don't know, a children's picture book, a farm is this perfectly serene, static place. You've got the red barn, the green rolling hills.
Maybe a cow just standing there.
Yeah, majestic, completely stress-free cow. It's peaceful. It's simple.
And it is completely and utterly detached from the actual mechanics of the business.
Totally. Because when we started looking through these insurance training modules for today's deep dive, specifically for farm property, that whole pastoral image just falls apart immediately.
It really does. You realize a modern farm is basically a high-stakes industrial complex. It just happens to be located outside.
Right. It's not just about, waiting for rain or watching corn grow. You're managing massive biological risks, heavy machinery that costs way more than a house. And paperwork then is, frankly, terrifying.
It is a totally unique intersection of risk, arguably unlike literally any other industry, because you have the residential aspect that people actually live there, right in the middle of the factory floor, so to speak.
Right.
Then you have the commercial aspect, manufacturing, processing, selling products, and then the agricultural aspect, living assets that can get sick, escape, attack you, or just, drop dead.
Drop dead, yeah. And that is exactly what we are digging into today. We have this stack of source modules on farm property insurance. We're focusing on Section 3.
The personal property section.
Exactly. We're going to break down how the industry categorizes this stuff on a farm, like scheduled versus unscheduled property. And then we're going to look at the causes of loss, which is essentially this wild catalog of all the creative ways the universe tries to destroy that property.
And we really need to be specific here. We are looking at the additional coverages, those weird edge cases that don't fit the standard mold, and then the hierarchy of destruction, basic, broad, and special forms.
I really want to start with the edge cases, because usually insurance policies are dry.
Right.
They're written by lawyers for lawyers. But this additional coverages section reads like a list of things that definitely happened to one unlucky farmer 20 years ago.
And so they had to write a specific rule about it. Yeah. That is usually how policy language evolves, actually. It's reactive.
Right.
You find a gap, someone falls into it, and you write a clause to bridge it.
The first one that caught my eye, and we have to unpack this because the logic is fascinating, is the fallen tree rule. Now, on a normal homeowner policy, if a tree falls, you pay to remove it. Simple. But here, there's this obsession with distance, the 250 feet rule.
It's a bit of a logic puzzle, yeah. This applies to the removal of fallen trees coverage. The policy distinguishes between a tree that falls near the house and a tree that falls well everywhere else on the acreage.
So walk me through the math here. I'm a farmer, a storm rolls in, massive oak tree comes down. Do I get paid to move it, or am I firing up the chainsaw for free?
It depends entirely on where it stood before it fell. The rule is based on the distance from the insured dwelling, the farmhouse where you sleep.
Okay.
If the tree was more than 250 feet away from the dwelling, and it falls due to a covered cause of loss like wind or hail, the policy pays to remove it.
Okay, that seems standard. It's out in the field, it's a nuisance, it's blocking a path, insurance covers it.
Right. But if the tree is less than 250 feet from the dwelling, so it's in your front yard, essentially things get complicated.
Okay.
The coverage for removal still applies, but, and this is a but it only applies if the cause of loss was not one of the major standard perils.
Wait, hold on. So if it's close to the house, less than 250 feet, and lightning strikes it, causing it to smash into the ground, the removal of fallen trees coverage doesn't pay. That sounds completely backward.
I know.
You'd think the closer it is to the house, the more coverage you'd want.
It does sound counterintuitive. But you have to think about how policies are structured to avoid redundancy. If a tree right next to your house is hit by lightning or fire, that damage is often considered part of the primary dwelling claim. Or there's debris removal built into the main structure's coverage.
Coverage, eh?
Exactly. This specific additional coverage is an extension designed to fill gaps. They exclude the big perils, fire, lightning, explosion, aircraft, vehicles, because those are supposed to be handled elsewhere.
Oh, I see. So this extension is for the weird stuff that slips through the cracks? It prevents double dipping, basically. You can't claim it under the house coverage and the tree coverage.
Exactly. It keeps the swim lanes clear.
But then there's the access clause. This was my absolute favorite part of the tree saga. Because usually if a tree falls in a driveway and doesn't hit a building, insurance says, good luck. No structural damage usually means no payout.
Correct. Generally, the tree has to damage covered property like a fence or a roof to trigger the removal coverage.
But there is a very humane exception here.
Yes. If a tree falls and blocks a driveway, or, and this is the critical part, blocks a ramp or fixture designed to assist a handicapped person, the policy pays to remove it, even if the tree didn't scratch the paint on the house.
That is such a specific human detail. It feels very uncorporate.
It acknowledges that for a functional property, access is as important as the structure itself. If you can't get into your home, or if a resident with a disability is trapped, the property is effectively damaged, though we should probably manage expectations on the payout.
Yeah, I saw the limits. You aren't getting rich here. They were pretty 1990s.
It's capped at $1,000 for any one loss, regardless of how many trees go down. And there's a sub-limit of $500 for any single tree.
So if a tornado flattens a grove of 10 trees, you're still only getting a grand max to clear the whole mess under this provision.
Right. Which barely covers the gas for the chainsaw and the sandwich you buy your neighbor for helping you. It helps, but it's not a windfall.
Okay, let's pivot from nature to finance. There's a section here on credit cards and electronic fund transfer cards.
A very modern addition to farm policies.
See, this is where my bias showed up. I don't associate farming with credit card fraud. I think of cash, or trade, or maybe a handshake deal, but the policy explicitly covers theft or unauthorized use of cards and even forgery of checks.
Farmers are business owners. They have corporate cards for fuel, for feed, for equipment parts. They have payroll. If someone steals the farm debit card, that's a significant business loss.
Right.
But the really interesting inclusion here, and one that points back to that roadside market image, is counterfeit currency.
Yes, the good faith acceptance clause.
Right. If you are accepting U.S. or Canadian paper currency in good faith, say you're running a pumpkin stand in October or selling hay bales to locals and someone hands you a counterfeit 50.
And you're busy. There's a line, you stick it in the box, and you don't realize it until you get to the bank teller who gives you that look.
Exactly. The policy covers that loss up to the limit, which is usually $500, with no deductible, by the way. It reflects the reality that a lot of agricultural commerce is still face-to-face and cash-based.
It's a nice safety net. Speaking of safety nets, or I guess holes in the net, let's talk about plumbing. There is a water damage provision that clarifies what happens when pipes burst.
Ah, yes. This is the infamous tear out and replace rule.
So, scenario. A pipe bursts behind the wall of the barn office. Water is spraying everywhere. The policy covers the water damage to the floor and the drywall, obviously.
Yes. And under this specific additional coverage, it also pays to tear out the wall to get to the pipe so you can stop the leak.
But, and here comes the kicker.
It does not pay to fix the pipe itself.
That always feels like such a gotcha. They'll pay for the drywall, they'll pay for the paint, they'll pay for the labor to rip the hole in the wall. But the actual copper pipe that caused the mess, that's on you.
It's a standard property insurance principle, but it confuses people every time. The pipe breaking is considered a maintenance issue or wear and tear. The result of the burst is the insured loss. The cause is your problem.
It's like if your car engine blows up and dents the hood. They'll fix the dent, but you still need a new engine.
That is a very accurate analogy. And while we're on plumbing, I saw a very specific exclusion that I feel is a personal attack on anyone with a basement.
Let me guess. Sump pumps.
The sump pump. The pariah of the plumbing world. The source material is very clear. Plumbing system does not include a sump pump, roof drain, or gutter.
Why do insurers hate sump pumps so much?
Because they fail constantly. They burn out, they get clogged, the power goes out during a storm just when you need them.
Right.
If you want coverage for a sump pump failure which causes backup and overflow, you almost always need a separate endorsement. Do not assume it's in the base policy.
Because if you assume, you will be bailing out your basement with a bucket while the adjuster shakes their head.
Exactly. Noted. Check your endorsements, people.
Before we leave the additional coverages, we have to mention the most gothic element in the entire document. Grave markers.
Grave markers and mausoleums. Yes.
Why is this in a farm policy? I expect to see silos, not mausoleums.
Think about the history of land ownership in this country. Many farms are multi-generational. There are family plots on the property that have been there for 100 years.
Oh, wow. Yeah.
Or the farmer is legally responsible for a plot in a local cemetery. This coverage treats those markers as property.
So if lightning strikes Grandpa's headstone?
The policy pays up to $5,000 to repair or replace it. It applies whether the grave is on the insured premises or away from it. It treats the memorial just like a silo or a tractor, an asset that needs protection.
That really drives home that farming isn't just a job, it's a legacy.
Hmm.
You're managing the past as much as the future.
Absolutely.
Okay, so those are the perks. Let's get into the meat of the policy, the actual stuff. The personal property. The documents break this down into 3 categories: coverage, E, F, and G. And the distinction here seems to be about how lazy you want to be with your paperwork.
That's one way to put it. It's about specificity versus convenience. Coverage E is scheduled farm personal property.
Schedule basically means making a list, right?
Yep. Exactly. You and your agent sit down and create a schedule. You list specific items. I have 1 Gastier combine, serial number XYZ, valued at $300,000. I have 500 bushels of grain, valued at this amount.
Now,
You pick items from the eligible list: machinery, livestock, tools, and you assign a specific insurance limit to each one.
so it's a la carte. You pay for exactly what you list.
Yes.
But there's a massive trap here, a huge red flag in the notes regarding grain and farm products.
You're talking about the growing crops exclusion.
This blew my mind.
Mm-hmm.
You look at coverage E, you see grain and farm products as eligible items. You think, great, my wheat field is covered.
And you would be wrong, and being wrong here is disastrous.
Why? How's a field of corn not a farm product?
In the insurance world, farm personal property refers to harvested assets. Grain in a silo, hay in a barn, pumpkins in a bin. Once it is harvested, it is property.
While it's in the ground.
While it is in the ground, growing, it is a biological entity subject to weather and soil risks. It is not property yet, it is potential.
So if a hailstorm wipes out your standing corn, coverage E does nothing.
0. For that, you need crop insurance, which is a completely different financial product, often subsidized by the federal government. Mixing the two up is a career-ending mistake for an agent and a bankruptcy event for a farmer.
Okay, that is a vital distinction for you to keep in mind.
Mm.
Harvested versus growing. So coverage E is the specific list. What is coverage F?
Coverage F is unscheduled farm personal property. Think of this as the blanket approach. Instead of listing every single shovel, wrench, wheelbarrow, and bag of feed, you just say, I have about $50,000 worth of miscellaneous equipment. And you insure the whole lot under one limit.
That sounds way easier.
It is, but you have to be careful with your valuation. If you underestimate the total value of your pile of stuff, you can get hit with coinsurance penalties later.
Right. And then coverage G.
Coverage G is other structures. This is the real estate that isn't the house. Barns, silos, fences, outdoor radio towers.
But never the farmhouse.
Never the farmhouse. The dwelling is coverage A. Coverage G is strictly the business infrastructure.
Okay, so we have the buckets, E, F, and G. But the notes mention that sometimes these standard buckets aren't enough. Especially for the high-value stuff, this is where we get into specialized forms.
Right. Sometimes the standard causes of loss in the main policy aren't broad enough for specific assets. Take expensive machinery.
Like that $500,000 combine we mentioned.
Exactly. You don't want named peril coverage on that, where you have to prove it was wind or fire. You want open peril coverage. You want it covered for everything unless it's specifically excluded.
Makes sense.
So you buy the mobile agricultural machinery and equipment coverage form. It separates that high-value iron from your general tools and gives it better protection.
And then there is the livestock coverage form. This is for the animals.
Cattle, sheep, swine, goats, horses, mules, donkeys.
It's a very inclusive list, except for one notable exclusion.
The poultry.
The chickens are kicked out of the club.
Yeah.
I feel so bad for the chickens in this policy.
They are completely ostracized. You can cover poultry under coverage E on the schedule, but you cannot put them on this specialized livestock form.
Why the discrimination against chickens? Is it because they're small?
It comes down to risk profile. Livestock, like cattle or horses, are generally studi. They die, but usually from distinct events. Poultry, they are incredibly fragile.
How fragile?
A sudden drop in temperature, a ventilation failure in the coop, a loud noise causing a smother where they panic and pile on top of each other.
Smother. That is a horrifying word in this context.
It is. You can lose 10,000 chickens in 20 minutes from a single fan belt breaking. The risk is so volatile that underwriters keep them far away from the standard livestock forms.
That makes sense. Sad for the chickens, but it makes financial sense. I also saw a note about coinsurance on this livestock form.
Yes. This is a financial trap for the unwary. You generally have to insure the livestock for at least 80% of its value.
What happens if you don't? Say I have $100,000 worth of cows, but I only insure them for $50,000 to save on premiums.
Then you have become a co-insurer. If a lightning strike kills $10,000 worth of cows, The insurance company won't pay you $10,000. They look at your math. You only insured 50% of the value. They might only pay 50% of the claim.
You can't just insure the front half of the cow.
Precisely. You pay the premium for the whole herd, or you pay the penalty at claim time.
All right, we have the property defined. Now we get to the finale. The causes of loss. This is the hierarchy of destruction.
It really is a hierarchy. We start at the bottom with basic, move up to broad, and reach the summit with special.
Basic is the standard chaos, right? Fire, lightning, explosion.
Plus the extended coverage perils. The industry uses a terrible acronym. WCSAVER.
WCSAJV. Sounds like a German shepherd sneezing.
It really does. It stands for wind, civil commotion, smoke, hail, aircraft, vehicles, volcanic eruption, explosion, riot, and vandalism.
It's the end of the world starter pack.
Pretty much.
But things get much more specific to farming when we step up to the broad form.
Broad includes everything in basic, plus some critical additions, falling objects, weight of ice and snow, which collapses barn roofs all the time. But the real key here is the additional broad perils specific to farm risk.
These are grim. I was reading through this list, and it really paints a picture of how dangerous it is to be a large animal.
It is. For example, electrocution of covered livestock.
Which implies what? They aren't sticking forks in sockets.
No, it's usually stray voltage, faulty wiring in a milking parlor, or lightning striking a fence line while the cattle are leaning against it. Since they are grounded and large, it's often an instant loss.
Wow. And then there is drowning.
Again, very common. Cattle wander into ponds to cool off, get stuck in the mud, and can't get out. Or floodwaters rise rapidly and sweep them into a ravine.
Accidental shooting.
That is exactly what it sounds like. Hunting season is dangerous for livestock. Or a farmer is trying to shoot a coyote, attacking the herd and misses. If a covered animal is shot, the broad form pays.
And speaking of predators, attacks by dogs or wild animals?
But notice the phrasing carefully. Dogs or wild animals. It usually excludes attacks by the farmer's own dogs.
Oh, interesting.
But if a pack of coyotes or a neighbor's loose dog gets in and mauls the sheep, that is covered.
And the last one on this grim list, loading and unloading accidents. I saw that collision is also noted here, but only for coverage E and F while in transit.
Yes. Animals panic. If you're trying to force a 2,000-pound bull onto a trailer and it thrashes, breaks a leg, or injures itself, that is a covered loss under the broad form. It acknowledges that moving these assets is inherently risky.
It seems like broad is the minimum you'd want if you have animals. Basic just doesn't cover the ways a cow actually dies. A cow rarely dies from civil commotion.
I would agree. Basic is for the building, broad is for the business.
And finally, we reach the top of the mountain. Special causes of loss. This is open peril.
Which means the logic flips. Instead of listing what is covered, the policy only lists what is excluded. If it's not on the exclusion list, it's covered.
So we have to look at the exclusions. Dishonest acts, pollutants, failure to save and preserve property. Those seem standard. But there is one exclusion here called voluntary parting. And I think this is the most terrifying clause in the whole document.
It is certainly the one that causes the most disputes.
Voluntary parting with property. Explain this.
It refers to being scammed.
Okay.
Let's say a guy pulls up in a truck. He looks like a legitimate grain buyer. He offers you a great price for your harvest. You load up his truck. He hands you a cashier's check, and he drives off.
And check bounces?
The check is fake. He stole your grain. Now, you might think, I have insurance against theft. My grain was stolen.
Right. It was theft by deception.
But the insurance company says, no. You voluntarily handed that grain over. You gave him the keys. You loaded the truck. That is voluntary parting, and under the special causes of loss, it is generally excluded.
That is harsh. So if he breaks into the silo at midnight, I'm covered. If he talks me into giving it to him with a smile on a fake ID, I'm bankrupt?
Correct. The insurance logic is that the insurer cannot underwrite your bad business decisions. It is your job to verify the check, to vet the buyer. If you fail to do that, it's a business risk, not a property risk.
That places a massive burden of verification on the farmer.
It does. And in an age of digital payments and sophisticated fraud, that line is getting blurrier. But as of now, if you hand it over, you usually own the loss.
That is a tough pill to swallow. But looking at this whole picture, farm insurance is really a hybrid monster, isn't it?
It is. It's part residential policy, worrying about driveways and credit cards. It's part industrial policy, worrying about machinery and pollution. And it's part biological risk management, worrying about animals drowning or chickens smothering.
It covers the gap between a barn collapsing from snow and a cow wandering into a ravine.
Exactly. And for you listening today, the key takeaway is that details matter. Knowing that a tree is treated differently at 240 feet versus 260 feet. Knowing that grain in the field is not grain on the schedule.
That is what separates a general understanding from true expertise. And hey, it makes you look really smart at dinner parties. Did you know your chickens need a different insurance schedule than your goats?
I find that works best as an opening line.
I'll try that this weekend.
Ah.
So here's a final thought for everyone to mull over. We talked about that voluntary parting exclusion. Think about what that means in your own life or business. We assume insurance is there for when bad things happen, but often insurance is only there for when accidental bad things happen. If you get tricked, if you get conned, the system often leaves you standing alone.
Trust but verify, especially if they are asking for the tractor.
Words to live by. Thanks for taking this deep dive with us. We'll see you in the next one.
Goodbye.